market environment, we're seeing that managing counterparty risk is vital in cash management. And today I'm joined by Travis Keltner and Jen Boss, and we're going to dive right in with you, Travis. So I want you to talk to me a bit about why this is so crucial to consider.
Yeah, so cash managers, one of the basic principles is don't put your balls in one basket. Diversifying your risk, because ultimately the risk is to the counterparty. You can mitigate that with collateral, but if you don't diversify, you're really exposed from a risk perspective, and diversifying that out is really the end risk of a counterparty defaulting, and that exposure's 100% in the door. But if you think about diversifying credit, that's just only one angle, one lens of why cash managers should think about, not only is it collateralized, unsecured, are there other forms of kind of risk kind of baked into the credit exposure, but there's other benefits to diversifying your counterparties. For one, think about having the ability to have price discovery. Price discovery is important because you want to be pegged to the market. You want to understand how trends are moving. One counterparty may price you a certain way and another may price you another way. You want to have exposure to that in similar products, whether that's dealers or other counterparties. Another way to think about it is, are you exposed to the best and latest products and yield enhancements that are out there? And so having those relationships across dealers and other counterparties, you'll be exposed and open to these other relationships, other products, other ways to think about how to invest and manage your cash. And really the last thing is really and one of the bigger things you should think about is the balance sheet exposures, and particularly the dealers. And so, whether dealers are based in different jurisdictions, counterparties have, different types of constraints around managing their balance sheets. And oftentimes there's a level of homogeneity with the kind of the dealer and the broader community that really shifts the availability of balance sheet based kind of on near-term spot dates. You think about regimes and kind of regulatory or kind of return calculations and measures, that it's important to have a broad set of dealers, even across different jurisdictional regimes, that can allow you to better manage how you invest your cash. And that falls back into a really key constraint that we've seen across our clients who are managing cash.
Now, I think, and you touched on it briefly, I think it's really important to closely look at the role of the dealers and understand why they're set to remain an important part of the funding ecosystem, but maybe not the only option. So, Travis, I want to stay with you. Jen, you're on deck. Why do you think broadening counterparties beyond traditional dealers would really help diversify risk exposures and potentially improve returns?
That's right. It's a great question. We tend to trust the dealers because we know the liquidity is there. We can depend on them. They can absorb the risk as an intermediary to markets. You think about longs and shorts, cash investors, cash borrowers. They kind of stand in the middle, and they're in a crucial role to kind of making financial systems work. That said, there's elements of the dealer that are kind of baked into the pricing of transactions, that are baked into the offerings provided today, that when you kind of pick it apart surgically, aren't always necessary. So if you think about other counterparties, big players, end users, or even intermediaries in their own right, kind of whether it's in the buy side or away from the dealers, or large other types of counterparties, they would be great counterparties to these cash investors. And how do you bring them into that? And that's what at State Street we're thinking about is we have a great community of clients who are looking to finance or invest cash, but they value the credit intermediation of a dealer. How can we provide that credit intermediation, going back to the original point around the counterparty defaulting, ensuring prompt liquidation, ensuring that they're not impacted, but also reaping the benefits of diversifying? And that's how we think about kind of peer-to-peer structures, our Venturi platform that we've launched, and really trying to better serve and widen and kind of keep the benefits I highlighted as those various reasons of why cash investors should have multiple counterparties, dealers, and other forms to better manage their cash.
Jen, I want you to help us explore a little bit deeper, right? So what are you seeing as our clients' key concerns when it comes to managing counterparty uncertainty?
Sure. So our clients, depending upon the type of client, if I use a corporate client as an example, they have different tiers of cash, and there's a different risk appetite for each tier, depending upon what it is. So earlier this year, when rates were high, we were seeing outflow from money market funds into bank deposits. Bank deposits were yielding higher returns. But with a bank, when the bank deposit, they're subject to the risk of the bank's balance sheet. And they don't always have visibility into what exactly that risk is. With money market funds, and specifically around the beginning of earlier this year, when regional banks were collapsing, we saw an inflow of money into money market funds. So with money market funds, clients have visibility into their underlying holdings. There is features within our portal specifically where they can see what that holding is, what their counterparty risk is at any point in time, whether they wanted to search, depending upon a market event, see, what funds are invested in a particular counterparty at any point in time. So another thing we're hearing from clients is they're not just thinking about their counterparty risk, but also their banking partner risk and how it impacts their daily operations. So clients are wondering, how can I manage my cash flows differently, where I'm not exposed just from where my investments are, but also what banking partners I'm using.
And Travis, why would central clearing counterparties help mitigate and reduce counterparty risk and also potentially, I think, support scale in liquid markets?
We use CCPs for the liquidity and the risk benefits that they provide. And so as a custodial bank, we like to use sponsored programs. We're heavy participants in the fixed sponsored repo program. This allows us to not only benefit and allow our clients to benefit from the risk mutualization that CCPs kind of bring to the table, which really takes it, kind of novates that trade away from a specific counterparty to a pool of risk that is managed and mutualized and really kind of taken a level and notch up through kind of processes, procedures, and kind of ways of liquidating when a member fails. That's very important. But frankly, the U.S. Treasury market is the most liquid repo market out there, but our clients want to be part of that. And so how can we bring them into that, provide them the benefits of liquidity, price, the opportunity to see how, the number of different types of ways we can, service them in these models, the range of products, going back to my original point. That's why CCPs really are great ways, and particularly sponsored models, to bring in those cash managers, the buy side, and also those looking to finance as well, into a pool, and also get the benefits of broader counterparties, but also an intermediary like State Street to kind of help channel those matchbook activities, which, if you think about the size of the market, really gives them direct access to a multi-trillion-dollar repo market that would be very difficult for them to do. They'd have to sign up, a number of counterparties to even get somewhat close to that without leveraging, our kind of access point through a CCP and the benefits associated with it.
Travis, Jen, it's great to see you as always, and thank you so much for joining me today and for a really wonderful conversation.
You're welcome. Great being here.
Great being here.
Thank you.